Hello and welcome back. Today, I am taking you through some of the basics of carrying out a fraud risk assessment. And as part of this presentation, what I will do is also take you through a couple of sample templates which you can use to put that theory into practice, whether you are carrying out a fraud risk assessment for your organization as an internal auditor or in your capacity as a consultant, or you're using those as an external auditor, or you want to use those as a fraud investigator who wants to plan and carry out his fraud risk assessment before you move on to your investigative procedures, or let's say forensic audit or a fraud audit. So let's begin with this. Moving on, this slide is a very simple list of points that you should keep in mind while carrying out any fraud risk assessment exercise, or you should keep in mind while planning or before planning. Let's say start with the basics. That is the first and foremost. Ensure that all formalities are taken care of. When I say formalities, with respect to your documentation, with respect to your mandate, you should have a clear mandate who's driving that kind of an exercise, because you have to have clear benefits coming out of this. And as a professional, one should invest time in research before you plan your project. you know uh, Keeping in view that there are going to be different fraud scenarios across industries, one should always look at what is the peculiarities of that particular industry, if there are any fraud risks which are typical to that kind of a business or a particular sector, so and so forth. And then ensure that there is awareness around the concepts, around methodology, and your team is well prepared. Everybody on the team should be on the same page as far as the concepts are concerned, as far as the methodology is concerned. And then ensuring compliance with the applicable professional standards, laws and regulations. Laws of the land always have to be kept in mind while doing any kind of fraud risk assessment, because sometimes these might lead to investigative audits and fraud investigations and forensic audits. And once it goes to up to that level, then you should not be deficient in terms of what you did as fraud risk assessment exercise. Then prepare and follow a structured plan and make sure that you have all the requisite tools and resources, be it your checklist, your background material, be it in terms of your access to repository, in terms of doing a research on the business, or if you are going to conduct it with some stakeholders, having those questionnaires in place. So all these kind of tools and resources you should have in place. And then follow a systematic approach and leave room for innovation and some of the non-conventional tools and techniques. So that also comes in handy at a later point in time, whenever you are doing some sort of an investigative audit, once you proceed ahead on the journey of this fraud risk as a topic. And then work as per the plan and ensure that the same is tweaked as per the environment and the business. Once you've understood the business, once you've understood the industry, there are going to be nuances whenever you are doing such an exercise. And make sure that you use both the conventional and non-conventional tools and techniques, just to ensure that at a later point in time you might require those whenever you are going for investigative procedures, using this as a basic starting point as a fraud risk assessment. Then make sure that you conclude the activities laid out in the plan. So it's always good to complete your plan on time, and whatever you have laid out in the plan, agreed with the stakeholders, ensure that it's drawn to a proper conclusion and you meet the objectives of the fraud risk assessment exercise, whether those are more of a precursor to forensic audit or a fraud audit, or those are just in terms of a compliance to the requirements of ICFR or internal controls exercise, or any internal exercise that the organization or your client might want to do. And always ensure that proper reporting of results is done. If you go to the standards by ICI, they very categorically mention a word called communicating with those charged with governance. So always ensure that your reports go out to proper stakeholders or those people who are in charge of these topics, and always work back closely with your internal audit team or whosoever is the stakeholder at the client, and you identify typical those kind of stakeholders at the start of the project. So that's some of the basic points that you should keep in mind, and we'll kind of build on these points as we move forward. So moving on with the basics, what you see on this slide is basically three sections. First talks about the fraud triangle, second talks about the anti-fraud measures, and third talks about the fraud action triangle. That is basically the financial crime that has happened and what are the next steps on that. So we'll go one by one on each of these. Let's say first talk about the fraud triangle. So this fraud triangle typically talks about three things. One is the opportunity to commit a fraud. Second is what is the intent behind that? It's a financial pressure or some other reason. Third is rationalization, which is basically the justification of the behavior of committing a fraud. Let's go one by one. Opportunity in terms of, whenever a perpetrator sees an opportunity, that opportunity might be in terms of weakness of internal controls, or it could be a sophisticated planned fraud scheme which he might want to carry out to gain a financial advantage. So the point here is, in any fraud, whether there is a financial opportunity or a sophisticated fraud to be carried out, there has to be a malicious intent. So that malicious intent links you back to the perpetrator, and once you go to the rationalization of the behavior, you uncover why that particular person committed that fraud. So these three things always kind of work in tandem. There is an opportunity, there is either a financial pressure or a motive, financial motive behind that fraud, or a non-financial motive. And then there is a rationalization of the behavior. So that's a three-dimensional aspect whenever you are wanting to understand a perpetrator. And why understanding a perpetrator is essential, because once you understand or profile a perpetrator, then you'll be able to identify more fraud schemes. The modus operandi, every fraudster will have its own thought process, his own modus operandi of committing a fraud. Second is anti-fraud measures. So what is anti-fraud measures? So first is prevention. Prevention is basically the set of controls that you implement to prevent that sort of a fraud from happening. And those could be in terms of your systems in place, your manual controls in place, your people controls in place, and all those kind of things. Second is deterrence. How do you deter that kind of a particular activity or a fraud from happening? Either by creating an awareness or by creating an environment which kind of puts the fear on people of a consequence. If they commit a fraud, they might be penalized or they might face severe consequences. So deterrence is also a two-dimensional kind of a thing. How do you deter a fraud? One is by creating an awareness. Second is by creating an environment which kind of prevents from those kind of activities from happening. And third is you go for a detection. You suspect that there is a fraud that might have happened. What do? You pick up the data, analyze the financial statements, data, records, information, interview the people, and you try and detect if any fraud has happened. So for which you have to have some red flags or fraud risk indicators that these kind of scenarios or these kind of conditions existed in the business which led to this kind of a fraud. And that is where the detection part comes in, so that once you detect a fraud or a possible fraud, then you prevent it in the future, same thing from happening again and again in the business. Third is, once you have detected a fraud that has happened, what was the modus operandi behind that fraud, how it got concealed for a particular period of time, and that is where you uncover the fraud or the fraud scheme. And sometimes what happens is, or many times what happens is, the conversion happens. A fraudster has siphoned off the money from the business and he's converted that money into some assets, or there is a layering of the transactions, so as to hide what has happened or has been done by the fraudster. And lastly, once you establish that the act is an financial crime, or it is against the law and policies of the company, you try and make a case of penalizing and going to either the court, or taking a penal action against the fraudster or the perpetrator. So these are some of the basic concepts that you should keep in mind before doing any fraud risk assessment exercise, because a lot of your controls will come out of these, a lot of your objectives will come out of these, a lot of your fraud scenario building kind of an exercise will come out of these. We'll go through those templates as we proceed on this presentation. I've taken a couple of examples which are there, and you can use these broad terms or build on concepts and kind of create those templates and carry out a fraud risk assessment exercise, at least at a basic level to start with. As the complexity of the business grows, obviously you would need more information, you'll need to think more on these topics. But for a basic, I believe this is something which you should always look for in terms of getting an understanding or developing an understanding on fraud and profiling of the fraud, and how it eventually leads to a uncovering of a fraud scheme. So we'll have a look at all these one by one. So moving on, now that you've seen what you want to do and what are the basics around that fraud risk assessment, or let's say the fraud triangle, or the fraud action triangle, or the anti-fraud measures. So those basic concepts, how you apply those, will be the process, and will be the next step in your journey of doing the fraud risk assessment. So let's say begin with getting a sponsor for the FRA. Typically, the board of directors, the audit committee, or the management, or the chief of audit, these will be the sponsors for your FRA. Or if there is a risk management committee, they might sponsor it. So depending on the nature of the organization and the governance around the organization, you'll get a sponsor for the FRA. And once you have the sponsor, the next step is formalizing the mandate. Whether you are doing this exercise internally within the organization or you are doing it as an external consultant, mandate is very important. From the perspective of doing it internally within the organization, you'll be needing certain information, you'll be needing to interact with people, you'll be needing support within the organization. So without a proper mandate, you might not get the desired level of support. And if you're working as an external consultant, and tomorrow if your FRA or this kind of an engagement leads to some sort of a fraud audit or a forensic audit, then the mandate and the intent behind the mandate becomes all the more important. So get your mandate formalized in place and work as per the mandate. Next is understanding the business and the transactions, probably one of the most important steps in these, because every business will have its own nuances, every business will have its own complexities. So you'll have to understand the business and the transactions and the complexity of the transactions to be able to use that understanding in coming up with fraud scenarios and building up hypotheses, and then testing that hypothesis with the data and information. One way to do it is collaborate with the people who have the knowledge of the business, who are working inside the organization, who've been into operations, who know the business processes, the systems, the people. So one way is to collaborate or interact with them. You can either go with a questionnaire approach, or you can either have somebody working back with you, helping you out with some of those complex transactions. So that is another way to do it. The next step is evaluate the current status and effectiveness of the anti-fraud control environment. Why you need to do this is, if you have to evaluate anti-fraud controls, you have to understand the environment in which the business operates. Let's say in a particular construction business, the overall anti-fraud environment might not be as strong due to the nature of the business, or sometimes due to the nature of the legal entity that you are working back with. So it all depends on how the controls are formalized, how the anti-fraud framework is set up, and the whole intent behind that. Again, this will link back to who is kind of sponsoring this kind of an exercise. If it has something like a backing of the board, then these things, or you'll generally find a anti-fraud control environment which is reasonably well structured and strong enough to cater to the fraud risk in the organization. Next is choosing a framework for evaluating the frauds and for carrying out the fraud risk assessment. Now, ACFE has a lot of information on this. They provide you with guidance. You can choose a framework, customize a framework as per your requirements, as per the expectations of your client or the organization, or as per the terms in your mandate. You can always choose a framework and customize it. Choosing a framework helps you in a way that it gives you a structured approach to analyze and review the things. Let's say any framework will start with governance and then move on to the process and how it operates, and it gets implemented, and then finally it gets reviewed. So it's something which is very structured. And to put things into context, once you understand the business, you understand the framework, it becomes easier for you to identify the tools and techniques you are going to use to carry out a FRA or further carry out a fraud audit or a forensic audit. So framework is very important and relevant in these times as well. And by the way, those are tried and tested frameworks. Then next step is identify the universe of potential risks and inherent fraud risks in the business. So like I said, every business has its own nuances and every business will have its own complexities. So inherent risk in any business will be there, fraud risk will be there. How you identify the universe, how you identify the potential risks will depend on your understanding of the business, the transactions, the business process, the anti-fraud control environment, or some of the anti-fraud measures that have been taken by the organization. Next is evaluate existing anti-fraud controls against the risks identified and perform a gap analysis. Once you know the risks, you evaluate the controls which are in place or controls which are addressing those risks or mitigating those risks. And you might come up with scenarios where some of the controls, anti-fraud controls, are not in place or those are not operating effectively. So the fraud risks are not mitigated as per the objectives. So you carry out a gap analysis and identify the cases where there are lacking controls, be it systemic controls, be it people controls, be it policy level controls. So this is one area which is again which will be the key to delivering results in this kind of an exercise. Next is evaluating the methods and schemes of frauds. So again, it depends on your understanding of the business, your identification of the risks. Like I said, every business will have its own nuances. It will have its own complexities. Every sector will have its own specific risk areas or fraud risk areas. So you'll have to evaluate those and then develop a hypothesis to evaluate the schemes of fraud which might be possible in a business. Next step is analyze the likelihood of each scheme and significance of the fraud risk identified. So likelihood again would depend on the extent of how well the anti-fraud controls are implemented, or how well the systems are being built and how those are addressing those kind of fraud risks or preventing those fraud risks. So a lot of emphasis on these will be how much of preventive controls are there, how much of detective controls are there. We've already discussed anti-fraud measures includes deterrence as well, and detection also comes as in a third step. So you'll have to evaluate all those scenarios and then come up with this kind of a thing. And to help you out, we have a sample Excel sheet within this presentation which you can use and fill in and do this exercise. So next step is map the existing preventive and detective controls to the fraud risk identified. I already mentioned this on the previous step. So once you've identified the fraud risk, you map the controls, you segregate the controls which are preventive, segregate the controls which are detective. So again, ideally there should be more preventive controls rather than more detective controls so that the control environment is more robust. Next is testing the operating effectiveness of the and the efficiency of the controls for the fraud risk identified. Once you've identified a risk, once you've mapped the control, you take out the data and transactions and test the effectiveness of those controls. There might be possibilities where controls are not working, those are not in place. To give you an example, a lot of companies might have a whistleblower mechanism in place, but there might be instances where no complaints are coming through that channel because people are afraid, because there is an environment which does not support this kind of a activity or this kind of a culture where people can go ahead and report possible instances of frauds or let's say conflict of interest or anything that could lead to a fraud. So these kind of scenarios you evaluate and then understand the business and then map those onto your sheet and then evaluate, and to further identify the residual fraud risk and inefficiencies and then perform a materiality assessment and collate all the results. Reason I say materiality assessment, because not all fraud risks or frauds will be significant to the same extent. Some might have a lesser impact due to the nature of the transaction, some might have a lesser impact due to the anti-fraud measures in place, or lesser likelihood of those happening due to the controls in place. So you'll have to evaluate while collating all the results. And finally, reporting against the objectives and concluding the FRA, and then documenting it and presenting it to the sponsors, to the stakeholders, and as against the mandate, whatever your mandate requires you to do, you stick to your mandate and perform the exercise to ensure that the objectives are being met. And what you do is more of a constructive exercise which takes forward the anti-fraud measures and the overall control environment and any enhancements that the management can do to prevent frauds or to detect frauds, or there could be systemic improvements coming out of this kind of an exercise where controls can be improvised or improved in the systems to prevent transactional frauds from happening. So this is one pictorial representation. You can create your own method around it. You can create your own process around it, but this is very basic level. Depending on, you're going to do a simple and basic exercise. If you were to do a complicated kind of an FRA in a complicated environment, let's say, which revolves around multiple geographies, you might have to build further steps on these. So this is just an illustration to help you out with this kind of a process, and I'll share one sample template within this presentation which will give you an overview how we put theory to the practice. So we'll move on with those examples in this. Moving on with the topic, now that you've seen what are the basics around the fraud triangle, the fraud action triangle, and the deterrence, you've also seen an illustrative process around sequence of steps you can follow to carry out an FRA. Now let's take an example where you want to do a fraud audit leveraging on your FRA, and you want to build further on your fraud risk assessment, and link back other aspects to it. Let's say fraud audit is one, forensic investigation is another, where you can leverage all these things that you have already done in the FRA. So for an audit, there will be an approach and there will be a methodology. Let's look at the approach first. Dealing with frauds will either be, with a passive approach where you test the internal controls, check the red flags, and you deep dive into the audit observations. And those could be internal audit observations or external audit observations, or any audit that might have been carried out in the organization, which would have reflected, red flags or those kind of fraud risk indicators in the organization. And second could be, you could take a reactive approach to fraud allegations, whistleblower complaints, internal tips through formal and informal channels. So this could be one of the key items in determining how your methodology follows. First, you have to figure out the approach, whether it's a passive or a reactive approach. Accordingly, you build the methodology. Now, your methodology will always depend on two things. One is that the scope or mandate you have. Second is the approach that you'll be following depending on the nature of the fraud or the allegation, or something which has come up in the FRA or something you've noticed during audit, depending on how you start with the particular transaction or particular business case scenario. Moving on with the methodology, a structured methodology always addresses all types of frauds which might be there, or you by design the fraud schemes which might be there. So these are some of the illustrative steps, not an exhaustive list. You can always build on this. Like I said, always use your mandate as your reference point. Whatever is your mandate, you build on it, and you can always leverage your fraud risk assessment exercise results and whatever FRA has been done in that particular organization. Let's say the first step would be creating an enterprise-wide category of frauds and identifying the types of frauds which associate with a particular business. Now here, construction will have different kind of frauds, real estate, infra, e-commerce, aviation, airlines, hotels, hospitality, healthcare, manufacturing. All different kinds of business will have different kinds of scenarios. That is where you'll have to identify and link back the frauds to particular type of business. And then cover the major operating units of the organization, the subsidiaries, the business verticals, departments, functions. Again, it depends on the mandate you have, to what extent you want to do the audit, what is your audit period, what is the length and breadth of the entire audit. But the main point here is that you look at all categories of frauds at a financial statement level, at entity level, process level, account or transaction level. Take an example that frauds at a financial statement level could be fraudulent financial reporting, misappropriation of assets, expenditures and liabilities for improper purposes or personal purposes, or funds being siphoned off by the promoters, or there could be liabilities being booked for third parties which are not genuine. So those kind of fraud schemes you can evaluate in that particular business. And then there could be also scenarios where fraudulently obtained assets and revenue and fraud schemes around costs and expenses. All those kind of scenarios would be there, depending on what sort of a business that you are looking at and what is the mandate. Then you cover all key business systems and accounts in the operating unit to ensure that there is adequate coverage of all types of revenues, expenses, and all those things. The reason I say systems and accounts, this is a very important aspect, because unless and until you understand the system in which the accounting and the recording and financial reporting is done, it will become very difficult to identify the modus operandi, or identify the complete trail of the fraud transaction. Then you identify the inherent fraud schemes. We've covered that in the previous slide as well, when we mentioned on the process that you evaluate fraud schemes during your FRA, and those will be essentially linked to the type of business you are looking at and the complexity of the business that is there. Then building fraud scenarios and identifying opportunities where frauds could have been committed. Let's say if you go back to the first slide where we mentioned the opportunity, financial pressure, and then there is rationalization of that behavior. So this is one aspect which is coming straight away from the basics, that you look at avenues where frauds could have been committed through evaluation of variations in inherent fraud schemes. Every business will have some sort of inherent fraud risk. Now, those might not necessarily lead to a fraud, but those will might be used to further layer the transaction or create a complicated scheme to commit the fraud or the financial crime. Then you evaluate the concealment strategies and characteristics for each of the fraud scheme associated with the red flags that you've already identified during your audit or the FRA, or any sort of prior investigation that you have done. And once you've done all this, you prepare a fraud audit program which is comprehensive enough to address all these scenarios, all these factors. And then this is something like a dynamic plan. This is not a static plan. This plan will be, kept alive during the execution, and will keep changing and evolving as you proceed on the investigation. Because typically what happens is, once you are into an investigation or a fraud audit, new scenarios, new kind of schemes, or new reference points, or new data might come up, which will give you a broader and a deeper perspective into the transaction or into the fraud that has taken place. Then you evaluate the data profile linked to each fraud scheme and evaluate if there is any collusion, control overrides. Quite possible that some of the frauds might involve the management personnel, or those could have been, targeted frauds which were essentially backed up by a, management intervention, or a conflict of interest in the business, and those kind of scenarios. Then you evaluate the use of specific tools and techniques for analysis. You, whether to what extent you want to analyze the data, how much of data is available, and you test the anti-fraud controls as well to confirm the hypotheses and scenarios that you built. So this building of hypotheses and scenarios is very important, especially when you look at in the context of evaluating different scenarios, and testing those with the data. So again, last step, one of the I would say important steps. I would not say last step, but one of the important steps is to perform the key activities as per the audit program, like a risk and control analysis, design evaluations, the effectiveness evaluation, to analyze if there have been collusions, if there have been conflict of interest, if there have been control overrides, to what extent technology has been used, how the controls have been abused by the management or any other person who was in charge of those controls. So all these kind of things you factor in your fraud audit program. That is how you kind of build the program. Again, I will stress on the fact that you have to always look at your mandate and scope of work, and the audit period, to build a program, to follow a structured approach and a methodology for carrying out a fraud audit or a forensic audit. And using the FRA, the fraud risk assessment results, will always help you to give better results, and to conclude the matter, or to conclude that there has been a fraud, and the magnitude of fraud, and the modus operandi of the fraud. So that's the basic. You can always build on it, and there is more content on the subsequent slides which will help you to kind of give examples and build further on this kind of a solutioning. In the previous slide, we discussed, carrying out an assessment around financial statement frauds, where we, also spoke about carrying out the assessment at various levels, let's say the entity level, the financial statement level, process level, account level, transaction level. So this is one illustration on, one of the key basics that we discussed around incentives and pressures. If you go back to the fraud triangle, one thing we discussed was, is there an incentive or a financial pressure? So this is one example of evaluating fraud risk considerations at a financial statement level. We are taking an example of a hypothetical entity, which is, let's say, ABC Limited, and we are evaluating if there are any incentives and pressures which might lead to frauds at a financial statement level. So let's go by some of these illustrative questions one by one. And please remember, these are illustrative. You can always build on these. There is a lot of reference material available on the ACFE website, on the AICPA website, and ICA websites. So this is just an illustration, a simple Excel template with broad questions. You can carry out an assessment and evaluate what are those pressures, what are those incentives, who are those people who might be, conflicted or, have those kind of pressures and incentives. Let's take one by one. So first one is the company or or let's say this company is into financial services industry. Is the company or the industry on overall economy facing a decline in customer demand and increasing business failures? So that's the overall environment at a very broad level. Second is the company facing high degree of competition accompanied by declining margins? Third, is the company unable to generate cash flows from operations while reporting earnings and earnings growth? Fourth, whether company has been experiencing unusually rapid growth of profitability, especially compared to that of other companies in the same industry. Now, if you look at these four questions, these are all interlinked. These are not to be looked in isolation. These have to be looked together as one, broad point with few subsets. So let's say, look at the question number 4 and question number 1. If the overall economy and the industry is going down, and company has been experiencing unusually rapid growth or profitability, especially when it compares to other companies in the same industry, then there is a possibility that something is misreported, or you might want to, deep dive into those things. How is this happening, to understand the trends, understand the reporting that is happening, understand how it is, coming up to that kind of a level. If it defeats the logic at some place, then you have to, catch hold of the system, even starting from the financial statements. And the fifth question is, are there any new accounting, statutory, or regulatory requirements that could impair the financial stability or profitability of the company? Sixth, is the company management facing excessive pressures to meet the requirements or expectations? That is, the expectations created by management in overly optimistic press releases or annual report messages or the earnings calls. Seventh, are there any indications that the company management or the board of directors' personal financial situation is threatened by the company's financial performance arising from significant financial interest in the company or significant portions of their compensations? Example, bonus stock options, earnout arrangements, being contingent upon achieving aggressive targets for stock price, operating results, financial position, or cash flows. Now, this gives you a perspective with respect to the preceding 6 questions. Now, are there management personnel who are responsible for, taking key decisions in the business? Are they conflicted to achieve certain targets which are unrealistic when the overall industry is going down? The similar companies have not been performing well. If this company is reporting something which is unusual, then you look at, are there any conflict of interest? So this is one key question that links back to all other questions on this particular slide, and going forward on the other aspects of this illustration. Then, whether there are any events or conditions that exist and indicate any other incentives, pressures to perpetrate fraud and intentionally misstate the company's financial statements. Now, if you were to look at the intention, you have to understand the pressures. You have to understand how conflicted the management personnel are. You have to understand their own personal financial interest in the business. If there are any arrangements which they are getting commissions on the revenue, or to inflate the revenue numbers will give them inflated commissions and all. So you'll have to evaluate different scenarios from different angles. But the broader point on this slide is evaluating incentives and pressures when you are looking at the financial statements. Moving on with the example, now that you've looked at the questions for incentives and pressures, the next step is you look at the opportunities. How do you evaluate if there are any opportunities in the business to commit frauds? So these are some illustrative questions which you can use, build further on these, and then you can evaluate whether there is an incentive and a pressure that meets the opportunity, and then there is a rationalization of the overall fraud or the fraud scheme that has potentially happened in a business. So let's take these questions one by one. Question 9. So we've discussed eight questions on the previous slide. So this is question number 9. Are there significant related party transactions not in the ordinary course of business, or with related entities not audited or audited by another firm, and whether there is a policy on related party transactions, and if the same is implemented? Whether the controls and compliance around related party transactions are checked and reported by the internal auditors. Now, this is very significant area, very widely used transaction, I would say, scenario which exists in the Indian context. So there are a lot of related party transactions in India, within the group companies, within the various entities which set of promoters would have. So one particular scheme that comes up in these is the undisclosed related parties. So there are disclosures to be made as per the applicable accounting standards or Ind AS, but sometimes what happens is a layering of the transaction happens. That is where those undisclosed related parties come into the picture. So those parties or those entities or those vendors or whatever be the nature of the entity are essentially in substance related parties, but they are camouflaged in a way that those appear as unrelated parties. So, and that is where the disclosures don't come up in the financial statements. Question 10. Are the company's assets, liabilities, revenues, or expenses based on significant estimates that involve subjective judgments or uncertainties that are difficult to corroborate? Now, basis your understanding of the business, basis your understanding of the financial statements and the profiling you've done so far and the FRA you've done, you should be able to assess this question in terms of whether those estimates are reasonable or those are very illogical, and whether those meet the situations of that exist within the particular sector or the industry or the company that you are looking at. Question 11. Are there significant, unusual, or highly complex transactions, including those close to the year end, that pose difficult substance over form questions or are in gross violation of the financial and regulatory reporting norms? Now, these type of adjustment entries typically in the Indian context happen near the year end, and those are typically reversed, let's say in the beginning or the first quarter of the next financial year. So you'll have to always be mindful of what was the last reported quarter, last reported financial statements, and when you're looking at the financial statements of the first quarter in the current year, you have to always look at if there are any deviations in the assumptions, or if there is something which defeats the logic of substance over form. So these are some of the questions you can build further, basis your understanding of the business, basis the complexity of the transactions that you're looking at. Question 12. Is there ineffective monitoring of management as a result of ineffective audit committee oversight or inadequate board oversight on financial reporting process and internal financial controls? Now, this is again very significant aspect, whether there are any sort of paper meetings happening, or actually the board meetings are not happening, but those are shown on paper that those are happening. So there might be multiple scenarios in this kind of a context, whether internal financial control evaluations have been done properly or not done properly, whether reporting done to the board is adequate or inadequate, These kind of things will give you some indicators that there are things which are wrong, and you can always pick up areas to deep dive into those areas, especially when it comes to the financial reporting process and the internal financial controls and the governance and oversight around these areas, which is very important in the Indian context. Question 13. Does the company have an unstable organization structure as evidenced by high turnover of senior management, directors, legal counsel, or board members, or inadequate monitoring over the operations of the company? So let's say if you see a lot of senior management people come in and leave quickly, that is not a good sign. You have to, then evaluate whether there is something wrong in the business. Once they joined, they noticed and they left the organization because they didn't want it to be on the wrong side of the compliance, or something which was happening in the business which was blatantly, I would say, against the accounting norms and against the rules and regulations. So this is another key aspect. You have to look at the organization structure for its stability as well. So this is again indicative. You have to always pick up on these questions and deep dive into these to, to come up to your next level of hypothesis or, scenario building. Question 14. Are the company's internal control components deficient as a result of inadequate monitoring of controls, including automated controls and controls over interim financial reporting, or high turnover rates or employment of ineffective accounting, internal audit, information technology staff, or ineffective accounting and information systems, including situations involving reportable conditions? Now, this is a very broad question. You can break it down into few questions, subsets of it, and then you can look at those and then come up with your hypothesis or, scenario building. So bottom line in this question is you have to look at internal controls, internal audit, and you have to look at the systems which are there in place, and if there are any, movements around the changes in the auditors, frequent changes in the IT staff, frequent changes in the accounting staff, and those kind of indicators lead you to something which is bigger and something which is larger, which is happening, at the back of the creation of the financial statements or presentation of the financial statements. Question 15. Whether any other events or conditions exist that indicate opportunities to carry out the fraud and intentionally misstate the financial statements. Again, these questions are not an exhaustive list. This is just on the topic of opportunities, and you can build on these. There could be more opportunities, more questions, depending on the business that you're looking at, depending on the complexity of the business and the complexity of the transactions and the size of the business that you're looking at. So these are just an illustration to help you build that template to carry out a fraud risk assessment at a financial statement level. So we've covered opportunities, we've covered incentives and pressures, and we'll cover the third aspect in the subsequent slide. Moving on with the example. So if you remember on the second slide, we had discussed a fraud triangle, wherein the third aspect was rationalization against the opportunity. So here we are just taking a small example in terms of few questions which you can evaluate in terms of coming up with attitudes and rationalizations, because what will drive the behavior is really the attitude. So these questions you should analyze and put it in context of how the financial statements are prepared and what's the overall environment and how those are presented and what is the really the tone at the top in the organization. So let's go by these questions one by one. First is, does the management fail to effectively communicate, implement, support, or enforce the company's values or ethical standards, or does it communicate inappropriate values or ethical standards? Next, does non-financial management excessively participate in or display an excessive preoccupation with the selection of accounting principles or the determination of significant estimates? So what is non-financial management? You'll have to look at the organization structure and evaluate who are the people outside the finance and accounts or the financial reporting team who are having an influence on the financial statements and the internal reporting that happens. Next question, is there a history of known violations of the Companies Act or local laws and regulations, for example, SEBI laws and regulations, or claims against the company or its senior management or board members or group entities alleging fraud or violations of applicable laws and regulations. Does the management have a tendency to commit to analysts, creditors, and other third parties to achieve aggressive and unrealistic forecasts? Has the management of the company failed to correct known significant deficiencies or material weaknesses in internal controls on a timely basis? Does management of the company pursue inappropriate means to minimize reporting reported earnings for tax motivated reasons, or there are accounting practices which are at variance from the industry norms? So here you'll have to put it in context of Ind AS, or typically the adjustments which happen in the accounting uh, system or the financial statements. You'll have to look through those items, non-standard journal items or non-standard entries. So you'll always figure out something which is not may not be the norm or may not be an acceptable accounting practice, but those are just starting points. Are there recurring attempts by the management to justify marginal or inappropriate accounting on the basis of materiality, or management makes frequent change in the accounting judgments and accounting estimates? Again, you'll have to go by the accounting norms. You'll have to look at the financial statements, evaluate these scenarios if these are the kind of things which are happening in the business. Whether the relationship of management with the current or predecessor auditor is trained. It's very important to look at how the management treats the external auditors if you're doing it as an internal auditor. And if you are an external auditor, you should also look at how the management treats the internal auditors. So you'll get to know if there are, relationships which give a reflection that there are disputes with the auditors on reporting matters, and the auditors are always pushed to either drop the issues, or information is not shared, or any sort of observations which have to be toned down or changed to give a different meaning to it. So you'll also look at those from this perspective. Does the management place unreasonable demands on the auditor, such as unreasonable time constraints regarding the completion of the audit or the issuance of the auditor's report? Now, this is one tactic which is very widely used in a lot of companies. First, the information will be delayed. Second, the access to the systems will be delayed, and eventually the auditors is pushed to close it within very short time periods where they cannot humanly check all the things which should be checked ideally. And that is where you might notice some deficiencies in the internal or external auditors documentation as well. Does the management impose formal or informal restrictions on the auditor that inappropriately limit access to people or information, or the ability to communicate effectively with a board of directors or audit committee? So again, I've said this point in the previous question as well. Again, all these questions are interlinked, and you'll have to look at in the context and what is your mandate and how you're going to go about the particular business for which you are analyzing the financial statements. Next is, does management exhibit domineering behavior in dealing with the auditor, especially involving attempt to influence the scope of work, or selection or continuance of personnel assigned or consulted on the audit engagement? All these factors might look normal routine, but one should look at these factors if they are alluding to something which is linking back to the misreporting being done, or any red flag indicators at a financial statement level. Last but not the least, whether there are any other events or conditions that exist that indicate the attitudes, rationalizations to justify the fraud or intentional mistake in the financial statements. Again, there might be scenarios where some mistakes are unintentional. Errors do happen. But going to the intent of that particular transaction or what is being done in the business, you'll have to look at the overall picture. Let's say something which is deliberately done in a construction sector might come up as a ad hoc transaction in any other sector, because construction is not their routine activity. So there might be genuine cases as well. There might be cases where things are intentionally done to camouflage or to hide out certain transactions, or to do a window dressing at a financial statement level. So these are illustrative questions. This is not an exhaustive list, but this gives you a flavor of how you evaluate the attitudes and rationalizations once you see that there are instances which could lead to discovering a financial statement level fraud. So we move on with the example, and I'll share a few more examples around the same topic. And there are a couple more slides on fraud scenarios for different industries. So those slides are at the end of this presentation. I think you will find those relevant as well. Moving on with the example. So this is the fourth section which you can plot in your Excel and you do an evaluation of the around each of these parameters or questions. So far we've discussed some questions around incentives and pressures, some around opportunities, and some around attitudes and rationalizations. So there might be other considerations keeping in view the nature of the business. So you'll have to come up with those considerations if you have to really complete your exercise at a reasonable level. So these are some illustrative questions which I've plotted in the Excel, and if you need the complete Excel, just drop in a email or a WhatsApp. I'll share the entire Excel piece with you. So next question is whether there is a mechanism for reporting frauds relating to asset misappropriations and conflict of interest, and whether same is reviewed by the internal auditors. Again, we go back to the previous slide where it was mentioned the point on ethics and values. So typically what happens is the ethics and values are generally communicated through the code of conduct and enforced with the mechanism behind implementation and review of the code of conduct. So conflict of interest is something wherein it might be actual or perceived, and somebody can raise a concern. And how do people generally go about it? They go from formal or informal channels, like we discussed in the previous slide. So you'll have to look at the overall environment, and if there is a mechanism for reporting frauds, you should evaluate that to or look at what are the results or what are the complaints which are there, and then try and correlate back it to your internal audit or external audit or the engagement that you are doing. Next, does the company have fixed assets that are susceptible to misappropriations? Let's say typically the movable assets, and some assets which are small in size, where the ownership is not really something which would bother a sellout of that particular asset in the market. So these sort of siphoning offs and these sort of small asset misappropriations do happen, and those can be unidentified for a long time as well. Also, is there a lack of appropriate management oversight of employees responsible for assets or high value transactions? For example, inadequate supervision or monitoring of remote locations for specific nature of transactions. Take an example of a company which is operating through multiple geographies. Now, management, do they have adequate staff for monitoring at each of those locations? You'll have to look at those. And if there are people who have conflicting duties, they can buy an asset and sell an asset and post it as a expense item and approve it at their own location. So these sort of scenarios might be there, or you can evaluate the environment through these questions. Next, is there a lack of an appropriate system of authorization and approval of transactions? Typically, like I took the example of asset purchase, and there could be other instances around contracting procedures or procurement related transactions or splitting of transactions to avoid coming to the head office for higher level of approvals and all. Also, is there a lack of appropriate segregation of duties or independent checks while validating, processing, reviewing, approving financial transactions? So again, this can be linked back to all the above questions, and you can evaluate the overall environment and even the systems, if those are built in to address the segregation of duties conflicts, and those conflicting duties are not assigned in the financial and accounting system. Also, are there legacy systems at the company which have weak application and system controls? And does the management have an inadequate understanding of IT, which enables the information technology employees or other users to perpetrate a misappropriation or indulge in misreporting? So typically, system weaknesses, you'll find a lot of cases where system control weaknesses and access rights are misused, or those weaknesses are exploited to commit those fraudulent transactions. So these will be something like which can happen in any sort of business. Next, whether the systems at the company are adequate to detect frauds once they have taken place and within the shortest possible time. So there might be instances where frauds are uncovered or undetected for a long period of time, and it's only coming up in, let's say, a next financial year. So there are no adequate safeguards, or like I mentioned in the previous slides, deterrence of those kind of transactions or detection mechanisms around those transactions. The systems are not smart enough to highlight those kind of transactions or even block those transactions. So again, you look at the context, look at the business, then evaluate the questions that you are going to assess your overall environment and overall financial statements in reference to those questions and scenarios. Also, are there access controls over automated records inadequate, including controls over review of computer systems, finance, treasury, customer, disbursements, or any other, transactions which happen in the accounting and financial softwares, and, how those are controlled, how those are, monitored for unauthorized access, or, access rights are reviewed and segregation of duties conflicts are removed on a periodic basis. So again, look at the next question, and then you can probably contextualize all these with respect to the business that you're looking on. So have you observed any unusual or unexplained changes in the behavior or lifestyle of employees who have access to assets susceptible to misappropriation or have authority to recommend authorized financial transactions, or working in specific roles, let's say credit officer in a bank, or let's say you look at how the segregation of duties is there, or if same person is approving, authorizing the transaction, and he's also disbursing the payments in any company. So those sort of things might kind of lead to frauds being undetected for a long period of time, and that is where you get to know that the behavior of particular employees is slightly different or odd in terms of the role that they are managing, and sometimes they also shy away from sharing the information that is necessary for doing an audit or a investigation or internal control review. So these are again some of the questions. You can build on these, come up with more questions, keeping in view the complexity of the business and systems. So I've already said that on previous slide as well. And last is whether there are any other events or conditions that exist that indicate incentives or pressures to perpetrate fraud or misappropriation of assets, or make use of system vulnerabilities, or somebody abusing the controls, and if that person is in a position of authority in the overall hierarchy. So you look at the org structure, you look at the systems, you look at the policies, you look at the vulnerabilities in the systems, if there are any, and if there is inadequate monitoring around the IT systems and the IT application controls. Those are all sort of areas to be looked into, so that you can come up with some sort of red flag indicators or some sort of fraud scenarios for building upon your FRA or the fraud audit or the forensic audit you're doing. Again, this template is illustrative, so these are 37 questions. These can be easily 47, 57, depending on the environment you're looking at, depending on the company you're looking at, and size and scale of the operations, and the entire length and breadth of the engagement that you want to do. So we'll move on with few more examples on the template side, and then one or two slides on different businesses and what all possible fraud scenarios could be there, which you can use and leverage, and carry out a full-fledged internal audit around those, or let's say a fraud investigation around those, or a fraud risk assessment around those, or a forensic audit around those. Moving on to the last section in this presentation, which is an illustrative template for carrying out the fraud risk assessment. And this template will act as a framework for you, where you can put all the things we've discussed so far into a single spreadsheet, and all the considerations that we've discussed in the previous slides. And you can just build on this template for any industry or sector or any company that you're working on. So before we do that, I'll just quickly do a quick small recap of what we have discussed so far. So we discussed the fraud triangle, the anti-fraud measures, we discussed the fraud action triangle, we discussed evaluating the overall environment and putting it in the context of financial statements, and looking at fraud risk considerations at a financial statement level. We also discussed at the FRA at different levels, covering the entity level or the business unit or the financial statements or process, function, department, transaction. So all those things we discussed in terms of the basics, and covering it in your planning or the FRA exercise. And we went through a detailed Excel having 4 sections, covering all sort of 37 questions around fraud risk considerations, which might lead you to red flags or red flag indicators at a financial statement level. So this template, if you look at on the left, you see identified fraud risks and schemes. So one is, let's say you have identified certain fraud risk indicators at a financial statement level, which you categorize at fraud risk relating to, let's say, financial reporting. Second is misappropriation of assets. Third could be misutilization of the funds. So there could be more scenarios, and to help you out with those scenarios, I've taken 3 examples of 3 different industries where I've created 3 fraud maps. and those are in the subsequent 3 slides. And that is one for banking, one for healthcare business, and third for manufacturing business. And once you understand the basics, you can create that sort of a fraud map for any business you are working on, even if it's, let's say, as complicated as airlines and aviation, or if it is something on the housing finance, something on NBFC, something on, e-commerce, you name it. You can just apply those same basics on different types of businesses and build the entire FRA into one Excel spreadsheet, which will act as your base document if you were to do, let's say, an audit around it, or an investigation around it, or maybe an internal control improvement exercise around this, or maybe improvement on the anti-fraud measures around the business processes that you're working on. So let's say first column you see is the identified fraud risk in schemes. Second is the likelihood. Third is the significance. So you make out what is the likelihood of that kind of a fraud happening. So you look at the anti-fraud measures, you look at the internal controls, you look at the systems, you look at the system vulnerabilities. We have spoken about all those in the prior sections, and that is where you map these with your understanding, and with your you can lay down a criteria and map those. And then the significance, whether it is a material risk, or it is something which is not material, which is the probability is low, and the significance of it is not that much because there is no legal consequence out of it, or a financial consequence out of it. So those can be the instances you can prioritize your risk basis the further exercise you want to do. Then third is the people and the departments involved, and then looking at the existing anti-fraud controls. What are those, be it in terms of the anti-fraud policy, the whistleblower, the vigil mechanism, the systemic controls where system has validation checks to prevent certain types of transactions, or something as basic as job rotation, something as basic as somebody's work being checked as by somebody else. And I'll give you one example for banking is, let's say there is a concept where people at a different positions, let's say in a credit department or a credit officer, is mandatorily required to go on a leave for 5 to 10 days in a year, and those leaves have to be taken at one single point in time. And that is where it acts as a anti-fraud measure, where his work or her work is checked by somebody else in the organization. So that's again in the absence of a person, you check something. So there can be numerous anti-fraud controls and anti-fraud measures which an organization can implement. And then you test the effectiveness of the controls, and this effectiveness is at two levels. One is at a design level, second is at an operating level. So design, we discussed, gave an example of whistleblower mechanism, whether by design that sort of a mechanism is there. And an operating level, we also discussed that there might be cases where no complaints are coming because people have a fear factor that they might be victimized, or something of an adverse consequence might happen to them. So those kind of evaluations you can do and look at the control effectiveness. Again, you can pick up some data and transactions to check whether these kind of controls are anti-fraud controls are working effectively or not effectively, whether those are by design they are effective or ineffective. And then the residual risk, wherever you see that there are inadequate control, there will be some residual risk which can still materialize. You can map those to individual items. And then the fraud risk response. Let's say a fraud risk has materialized. The logical response is carry out an investigation. You see that there is some data which is indicative of a red flag, and those kind of indications are supported by your hypothesis and your scenario building. And the next logical step that will come is, as a response, you should investigate that, provided it is within your mandate, provided you have a go ahead from the management. So these are the basics which you should keep in mind when you're doing an FRA exercise. If you need this Excel or any other Excel sheet in this entire presentation, or a copy of this presentation, just drop me a SMS or direct message on LinkedIn. I'll be happy to share it. So next is 3 fraud maps for 3 different industries, which can help you carry out the FRA for to any extent you want to. Obviously those are illustrative, those are not exhaustive, but you can use those, then go back to the concepts, basis your understanding of the business, you can build those further. And for any business you can build those once you have the basics clear. Moving on and building further on the FRA template. Now, this is another template which gives you a micro level view of, carrying out an assessment around fraud schemes at a process level, let's say. So we've discussed carrying out the, fraud risk or evaluating the fraud risk considerations at a financial statement level. Now you want to move at a particular process and evaluate what could be the potential areas where there might be frauds or which are susceptible to frauds, or where there are specific fraud schemes which typically happen in those areas. And by area, by process, by business function, you can evaluate those and look at the potential frauds, and then build a hypothesis around it and test your hypothesis with the data to substantiate whether a fraud has happened or not happened. So this is again just an extension of the previous template. You can either have a separate worksheet, or you can have a separate workbook around it, just to test your samples and test the data and validate your assumptions or hypotheses or scenarios that you've evaluated. So let's go one by one, and I've just taken 4 examples just to keep it short and just to give you an overview perspective. First is, let's say, area of general purchases and accounts payable. So typical fraud scheme could be a direct payment scheme. And what could be the potential frauds? Let's say one could be payments to vendors not in the vendor master data, and payments done to one-time vendors through direct GL postings and without proper supporting and proper underlying documents. And then payments to vendors that match the employee address or mobile number or credentials of the employees, indicating that some employees might have a conflict of interest. They are introducing vendors who are either their friends, or they are doing some layering within the organization. Then payments to vendors with no activity in the past 1 year or more than 1 year. So there was a vendor balance which was there or created in a prior period, and for 1 year or some period of time that account remained dormant, and suddenly there is a payment in that. That is one possible area where it could be a something like a uh, payment which is not genuine or which is not supported with genuine documents, because those are pertaining to previous periods, and just to give it a break in between, there could be a scheme around it. Then duplicate payments to the same vendor, double payments against the same invoice, leading to non-moving debit balances, and same invoice double booked, and then both the invoices are paid off, leading to nil balance in the vendor ledger account. So these kind of schemes can be there. What you can do is evaluate each of these schemes with, or build hypotheses around it, and then test it with the actual data which is there. You can apply your logics to the entire population and figure out if there are any sort of fraudulent transactions in these. Again, this was the direct payment scheme. There could be indirect payment schemes as well. Let's say, to give you one example, increasing trend of payments to vendor, and or increasing trend of purchase order prices for items ordered. There's one typical vendor where the item price keeps continuing. Once that vendor got empaneled, then the prices without adequate quotations and all those are hiked up, and inflated payments are made to the vendors. Then routing the corporate payments through employee accounts and long outstanding unsettled balances in the employee ledger accounts. So like we discussed in the direct payment scheme, where the payments to vendors are matched with the employee addresses and employee credentials, so indicating a conflict of interest. How do you prove that whether a fraud has happened actually or not? So you look at those employee accounts, you look at those vendor accounts to see if there are certain transactions which prove the hypothesis right. Then payment made to employees are not supported with underlying documents and are actually made to vendors by routing through the employee accounts, again indicating conflict of interest, indicating layering of transaction, and making it into an indirect payment scheme. Then third possibility could be fictitious payments, and there could be payroll fraud schemes. To take an example, payments to employees are not employees who are not there in the HR master data, or employee master is deleted from the ERP system. You can always look at the logs, or there are certain payments which are made to employee IDs or employee accounts after the employees have left the organization. So these sort of indications are clear cut fraud scenarios wherein you need to investigate and identify why such payments happened. Were those systemic errors, or there was an intent behind it, or somebody used those accounts to siphon off the money? And then payments to employees with invalid credentials, or those credentials are changed, or being created as one-time vendors for payments, and again those not being supported with proper underlying documents, or there is those being reported or accounted or posted and then paid in different accounting periods. Then payments to employees with ID same as another employee, maybe same ID in two different ledger accounts, or if the ERP system allows, it is a legacy system, it does not have adequate validation checks, or those credentials are changed. Let's say there was one employee who left the organization, the credential of the other employee were changed, or bank accounts were changed and nobody checked it, and eventually somebody posted a payment into a bank account which belonged to somebody else, and not the employee but a vendor particularly, or again a layering, or that sort of a transaction might happen again. So these are illustrative in nature. You can build on these further, and then you can look at instances where there could be possibilities of bribery and corruption. Again, it's an indirect payment scheme, where you evaluate if there are any significant amount of soft expenses, like consulting, marketing, advisory, or payments being made to lawyers, or routed through non-routine kind of vendors, or typically which do not have much relevance to the business of the company. So those are typically the third parties, or the agents, or management controlled entities, and where is no verifiable delivery of service, or any legitimate business need for that kind of an expense. That is where you look at those soft expenses and investigate further to build a hypothesis and test with the data and look at the underlying documents. And you might also, once you have all the facts in place, you might also discuss those with management personnel or people who are making the payments, kind of interrogate them, or interview them. Interrogation is probably not the right word at this stage. Maybe interview them to see if there is a rationalization behind that kind of a transaction or not. Again, this is an illustrative template. You can just build on the fraud scenarios for individual areas, which will help you to build on your FRA exercise to carry out an investigation at a later point in time, once you have identified the red flags, or you have identified the fraud risks which are there, or you have identified certain fraud risks which have actually materialized. So you build hypotheses, you create scenarios, or you evaluate scenarios and test those with data and information to substantiate the facts. So this is one illustrative template which you can build further very easily. It's very flexible to work with. Now, moving on to the example. So like I mentioned on the previous slide, you can have a fraud map to evaluate all the scenarios which might be applicable for a particular type of business. So in this slide, I've taken the example of a healthcare business. And within this context, a lot of people also use the word fraud tree. That is basically the same concept, but this is much wider in terms of the coverage, and a lot of scenarios are built into this. And the reason I say it mapped, so it covers the operational aspect, the financial aspect, the IT controls and everything. So you can, again, this is illustrative. You can build on this, basis your understanding of the business, basis the environment that you're working in, basis your mandate. So this is more of an illustration. So I'll just take few broad headers on this, and then we can move on to the next kind of a business where this sort of a map can be created. So this map is essentially coming out of the understanding of the business and your understanding of fraud risk as a concept, and whatever we have discussed so far, this is one practical application of it. Let's say in a healthcare business, there could be healthcare service related frauds. There could be promoter and management related fraud schemes. There could be fraud schemes in the revenue and billing. There could be fraud schemes within medical records and documentation related frauds. There could be a lot of fraud schemes around bribery and corruption. So there could be a lot of fraud schemes around financial statements. So there could be fraud schemes around technology. So you have to evaluate the entire landscape. Let's say, take the example of the financial statement frauds. So these sort of things will come out once you go through the template that we have discussed previously, where you look at the fraud risk considerations. Once you look at the fraud risk consideration, you identify specific areas, and you use the two kind of templates which we have discussed previously. Then you can easily come up with these kind of scenarios. And these financial statement level frauds can be industry agnostic. Something which might happen in healthcare might also happen in any other sector, because those are driven by management, or driven by conflict of interest, or any other reason for that matter. So again, technology related frauds will also be to some extent. Let's say cyber attacks is a common scenario, or hacking is a common scenario, which is not very specific to a particular industry. So you can build a fraud map, then pick out the scenarios, use the previous two templates to build on the scenarios, and see what are the anti-fraud measures, what are the controls in place, how this is working out. So this sort of a map, you can extend it to any extent you want to, depending on your mandate. If you want to do a complete holistic exercise, or let's say detailed fraud investigation for let's say an enforcement agency, you would need these kind of scenarios, because you never know what sort of a scenario or a fraud scheme the fraudster has used until you reach a profiling. I go to a level where you have done the fund trail, you have done everything, you've done you know all tracing and everything, and then you come up with that this was the modus operandi of the fraud. But you'll have to pick and choose between these items and then apply to the relevant business and see how these might have worked out. And it's all about building hypothesis and testing it. That's something which will happen as you proceed along in your investigations and all. Take the similar example of manufacturing business. So manufacturing related frauds, again, the reason I say this is a fraud map is something that is supposed to help you reach a particular objective or a place in a particular direction. So unless you understand the business, unless you understand your mandate, unless you understand the complexity of that business, you will not be able to uncover many fraud schemes. So again, it all depends on to what extent you understand the business and to what extent you understand fraud risk as a concept. So this is a map which can be applied to a manufacturing business, and there could be frauds again relating to promoter and management, production and inventory related fraud, procurement related fraud, sales and revenue related fraud schemes, financial statement frauds, bribery and corruption, technology related. Again, this is the entire kind of landscape which is illustrative. This is not an exhaustive list. You can build on this using the concepts that we have discussed so far. So this is just to enable you to come up with the scenarios, and then once you've built the hypothesis, you test the hypothesis with actual data. Once you test it with actual data, you will come up with a lot of fraud risks, a lot of fraud scenarios, or actual frauds while even doing your fraud audits or internal audits for that matter. So this is another illustration relating to manufacturing business. And finally, the third example is relating to the banking. So there could be frauds relating to account operation. There could be frauds relating to cash and treasury. There could be documentation related frauds, which are very common in the Indian context. So there could be card related frauds, technology related frauds, again, bribery and corruption, financial statements, borrowers submitting financial statement to banks. So there is a dual aspect in banking. One is the financial statements of the legal entity itself are fudged, or those are window dressed. Second is the borrowers who are submitting the financial statement to bank for their credit and extension of credit. Those financial statements, again, even though you might categorize those as documentation related frauds, but those are the type of frauds which are very typical and very common in banking. So again, the idea is and take home message is understand the business, understand fraud risk, understand internal controls. Understanding of internal controls and anti-fraud measures is very important. If you have to evaluate and see, fix responsibilities, who's done it, who's part of it, who has kind of enabled it, or who is the person who has shied away from his responsibilities or not carried out his responsibilities with skill, care and diligence. Because if you look at the Companies Act in India, it uses the word that directors have to act with care, skill, and diligence. So if they delegate something, they don't verify it, and a fraud happens, directors cannot escape their liabilities. So fraud as a concept is very complicated. It's always easier said than done, but you should always have adequate resources. Your team should be aware of the concepts, and I hope this video or this presentation helps you in clearing some of the concepts, and the presentation enables you to kind of do this in a structured way, and you can always build on this further. This is a very basic kind of a presentation that I'm offering you as something on the topic of fraud risk. And to start with, if once you've started doing this, you will enjoy the journey, because there is a lot of things which are new in the fraud and forensic domain, and the more you do it, the more you will enjoy it. So these are the basics which you can build on it. And if you need anything on the topic, feel free to reach out or connect on LinkedIn, or connect over WhatsApp. We can always have a chat around, share knowledge, share ideas. That's always a helpful way to progress along. I hope you find these useful. Thank you so much for taking your time out, and thank you so much for spending time on this entire presentation. Thank you so much.